Greetings, Ted Hicks, founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Tuesday, March 1st, and this is our monthly market monologue. Obviously, the big news across the world is Russia's invasion of Ukraine. We'll talk about how that has impacted the markets as well as where we're at year to date. So let's dive in. So first up is we're going to look at a slide that I published in a short video that I published Wednesday morning, February 23rd. This candle is the Tuesday, February 22nd. And that day, Tuesday, the market closed right about at 43.04 is what the indicators are saying on the right. And I said that that's important because this same level ended up being a support level from back in October. And so the question at the time was this level going to hold as support, or would the market fail to hold that level? And in which case we might say, look out below, no telling where the next natural support level might be. So what happened is the market closed lower. This again is Wednesday, the 23rd, this black candle here, and a fairly negative day in the stock market. Russia invades Ukraine that day. And then the following day, this is Thursday, February 24th. And what I want to highlight is the market closes at this level. It opens on Thursday down at this level. So that's a gap down of 1.7%. That's a nasty open. The market actually then trades down so that from the prior day, Wednesday, to the intraday low, it's actually a drop of about 2.6%. And then what happens is we get a very quick reversal. So the market actually rallied 4% from this intraday low all the way to where it closed. A very strong reversal, which is always good to see. The following day, which is Friday, February 25th, we again have a pretty good day, failed to reach that 200-day moving average, but still nonetheless a good day. So we might ask, is this, have we put in a low or not? Now this is Monday the 28th. Monday, again, we tried to get to this 200-day moving average, and we could not do it. And so the question really becomes is this Thursday and Friday, does this end up marking the bottom? Have we recovered? And I would like to highlight the multiple seasons of North Carolina, because if you're living here in North Carolina, we just witnessed this where we flipped to 70-degree weather one day last week, and the very next day the first temperatures in the morning were in the 30s. So that is entirely possible. What happened is that this wasn't indeed a low, it was more of a head fake. Kind of like that false emergence of spring. In the stock market parlance, we call this a dead cat bounce. And it appears that it was caused by short sellers covering their shorts because of this market rally on Thursday. So who knows if that's true or not, only time will tell. But where do we stand year to date? On the screen right now, we have the three main indexes that the news media likes to report. The Dow Jones Industrial Average year to date is down about 6%. Keep in mind, whenever we talk about this average, it is only 30 stocks. So it's really not a good measure for us to be monitoring. I only bring it up because the news media talks about it all the time. And then the NASDAQ, this is CompX, is the ticker symbol in my system. NASDAQ index is down actually 12% year to date. And the S&P 500, the index that we were just looking at, year to date is down about 8%. So that's where we're at for now. Okay, now let's switch and talk about the various sectors of the S&P 500. Standard & Poor's breaks up the S&P 500 into 11 different sectors, and I've got those sectors on the screen now. And what I want to highlight is the fact that there's really only one that's positive year to date. This is financials, it's negative 2.5, and this is consumer discretionary, negative 15.6%. So everything, all 10 of the 11 sectors are negative. The only sector that's positive is energy. So we happen to be overweight energy. Now you understand a little bit why. So now let's talk a little bit about what I refer to as the vertical speed indicator. The vertical speed indicator, as a reminder, is a compilation of 14 different technical indicators that I look at. I look at a lot of them, a lot more than that, but I take 14 of them and I roll them up into one, what I call a composite indicator. That's what the vertical speed indicator is. It is indeed a cheesy reference to my love for aviation. And so first off, let me remind everybody what we're not trying to avoid. We're not trying to avoid every wiggle in the stock market. That's a fool's errand. We're never going to get clients in the market at the bottom and out at the top. That's not realistic. But what I am trying to avoid is I'm trying to avoid these really long, protracted bear markets. On the screen right here, this is 2007 and 2008 from the top. And again, these candles are color coded based upon the VSI reading at the time. And so you can see this was in September of, this is September of 2007. The market came down, but I didn't get a flip to the to no man's land in the terms of the VSI. That happened here. Then we're back on a buy signal. And then we finally flipped back to a red signal. And then we were on that red signal for quite a long time. That's really what this is trying to do, is when the VSI flips to a sell signal, historically it tends to be on that sell signal for a time. That's what we're trying to avoid, is because most of our clients would tell us, I never want to go through something like that again. Of course, I can't guarantee that we're always going to avoid bear markets and things of this nature, but we're trying to put things in our favor. Something else that we've been talking about for quite a long time is this time period. On the screen right now is 1965 through 1979. Now, the vast majority of the folks in this industry talk about that you should be invested for the long term. Well, this is a long term. This is 15 years of actual stock market history, 1965 through 1979. And if you did the math, not counting the dividends, you ended up with approximately a 2% rate of return if you were invested in that index and you held throughout all of the gyrations. That is first of all, that's the average rate of return. A 2% rate of return from the beginning to the end, divided it by the time period. On average, you got a 2% return. But if you look at the screen, you got anything but an average return. It was a very, very violent time period in the United States stock market. There are certainly some corollaries to what's happening right now as to this time period. We now have a war going on. We have high inflation rates right now. Well, back then you had Vietnam. You had high inflation rates. So this is something that we're trying to be very cognizant of, is that if we go through a time period like this, can the traditional buy and hold mentality of, hey, I'm in it for the long haul, can that work? And again, if you're 50 years old entering into a time period like this, by the time you get out of it, you're 65. So that's how we're looking at things. We don't think we're in an environment where we can just put something in a portfolio and leave it alone. That's why we are active in our portfolio management. So when it comes to the VSI right now, this is where we're at. I just updated this morning. I'm not obviously showing you what indicators I'm using. Those are proprietary, but there's 13 of the 14. There's another one not shown. It is on a sell signal as well. That's where we're at. So let's go back and talk about the day Russia invades Ukraine. I wasn't even at the office yet, and our main line, the 851-5512 number, that line is text enabled. So I wasn't even at the office just yet, and we got a text message from somebody saying, hey, should we go to cash? They were implying about the money that we are managing for them. I'll come back to that. About an hour later, I got a request from another client asking about their 401k, the account that we cannot manage for them. So I'd like to talk about both of those questions. So what's on the screen right now is a representation of our moderate model. Moderate being defined in the traditional sense from a risk spectrum from very conservative to very aggressive. This is for the individual that is kind of allegedly right there in the middle. Well, our models are made up of what we call sleeves, okay? Well, somebody said this, it looks like a pie, so shouldn't they be called pieces of pie? So, fine. So each of the pieces of pie represent a different investment strategy, okay? And each one of these strategies put together makes up the entire pie or the entire model for the client. Now, obviously, this is a moderate allocation, so moderate aggressive. We're going to tweak some of those pieces are going to be bigger and some of those pieces are going to be smaller. And moderate conservative, same thing. Some are going to be different sizes. That's how we're going to dial up and down the risk in the traditional sense. But what I want to get across is the fact that we're looking at multiple different investment strategies that all fit together into one investment account and one investment model. Some of those strategies are already in cash, and they've been in cash for a while. I don't remember the date off the top of my head, but it wasn't recent. Okay, I think the entire month of February, the dual momentum sleeve was in cash. The VSI sleeve, however, was not in cash. Based upon the slide that a couple seconds ago that you watched, the VSI is now a composite. The composite VSI is now on a sell signal. So the VSI sleeve is now, as of this recording, that too is in cash. And so we're already fairly heavy in cash. And then today we added to that cash pile inside of the model. Now, we're not 100% cash, and I'm not recommending that you take your investment portfolio 100% cash. Please don't read into that. Okay, this is for money that we're managing. And because we're able to manage it and we can make changes fairly quickly, it is different than what we would recommend a client do in a 401k. I've been doing this now for about 23 years. And I can't tell you how many times a client would come in and say, hey, Ted, I changed the allocation in my 401k like you suggested. And I say, great. When did you do that? And they would say, last night. And I would reply, I gave you that recommendation 6 months ago. Okay. So we are fiduciaries, so we take our advice very seriously. And if we give you advice, but and that advice is based upon the current market conditions, but we have all the evidence to suggest that you might not implement that advice at your 401k, then that's going to color how we give counsel for a client's 401k. Okay. So as it relates to should we go to cash, that text message to that first client, I responded to them, we're pretty much already in cash. Now, again, some of these pieces of pie are not in cash or not 100% in cash. And so again, this is a multi-strategy approach so that each strategy stands on its own. Now, the reason we do this is because there's no such thing as an investment strategy that works in every single market climate. So again, this represents a moderate allocation for an account that we are managing at Hicks & Associates Wealth Management. This is not a recommendation for you to implement in your 401k or elsewhere. However, we can then take that into the next logical step and remind you that if you're over the age of 59 and a half, you might very well be able to do what's referred to as an in-service distribution. So even if you're still working at your employer, you might very well be able to take your 401k and roll it out into an IRA. Now, regardless of whether you're managing that yourself or we're managing it for you or you hire somebody else to manage it for you. The reason you might consider doing that is most 401ks are limited in terms of the investment vehicles that you have available to you. For example, our sector rotation model or our sector rotation sleeve or piece of a pie, I should say, that sleeve is kind of a go anywhere type of a sleeve. The things that we're invested in that sleeve, I don't know that I've ever seen those types of investments inside of a 401k. And again, a 401k is not designed to be an investment account. It's designed to be a retirement or an employee benefit. There's a difference there, and I won't go into details on that now for sake of time. But the point is, we wouldn't recommend doing something like this in a 401k, in part because you can't. Okay. So if you are over the age of 59 and a half, you might consider doing an in-service distribution. Now, some retirement plans allow you to do this at age 55. Likewise, if you have an old 401k that is from a former employer and now you've left and gone to a different employer, same thing. You can take that old 401k and roll it into an IRA. Again, whether you did that with us or you did that on your own is irrelevant. You still technically have that ability to do that. Naturally, if you have any questions on that, or you want to talk to us, by all means, feel free to reach out to us. I will make sure you have the contact information on the screen. Hopefully that helps in terms of how we're allocated and answering the question of should we go to cash. We already kind of are there, and what to do in a 401k. Again, we tend not to be that active in 401k simply because you can't. So I hope this monthly market monologue was helpful. If you have any follow-up questions, by all means, feel free to reach out to me or my team. Our contact information is on the screen, and we would be more than happy to assist you. Again, as a reminder, you do not need to be a client in order to ask a question. By all means, feel free to reach out, and we would be honored to serve you. Thanks for watching.